In this video, we are going to talk about, stock market will crash. So, before starting the video, please like this video. Do subscribe and turn on the notification to our channel, and check out my Instagram and Twitter at IronCorman for future updates. Taken as a whole, the stock market has had another fantastic year. On a year-to-date basis, the benchmark S&P 500, SNP Index, GSPC, was up 20% through Wednesday, December 1st. This is a strong performance considering the widely followed index has averaged an 11% total return, including dividends, over the last 40 years. The stock market, on the other hand, has been topsy-turvy in recent weeks, with volatility returning in a big way. We may not like to think of stock market collapses and double-digit percentage corrections as investors, but they are the price of entrance to one of the world's most powerful wealth producers. There are plenty of catalysts right now that may tip the S&P 500 into its first fall or correction since the pandemic began. The stock market might implode in the next 3 months for 9 reasons. Let's start with the most obvious: the coronavirus and its countless forms. The S&P 500 has set more than 6 new highs this year. It was hoped that growing vaccination rates in the United States and around the world would allow businesses to resume normalcy. However, with each new COVID-19 version, the possibility of additional lockdowns, restrictions, supply chain problems, and a potential drop in consumer or corporate expenditure increases. For what it's worth, the introduction of the Delta variation in May caused a brief market blip that was quickly forgotten. The same might be said for the Omicron variety, but we simply don't know enough about it now for Wall Street and investors to be confident in making stock purchases. Inflation at an all-time high. In a growing economy, some level of inflation, i.e., rising prices of goods and services, is expected. However, the Consumer Price Index for all urban consumers increased by 6.2% in October, reaching a 31-year high. Inflation is an issue because it has the ability to reduce consumer and business purchasing power. Even while employees' incomes are increasing, increased rent/home costs, significantly higher energy prices, and even above-average food inflation could sap much of their purchasing power. If the next few inflation figures from the U.S. Bureau of Labor Statistics come in at or over 6% over the previous 12-month period, the chances of this price increase being temporary start to fade. That won't sit well with Wall Street, experiencing dyspepsia as a result of rising energy prices. Over the next 3 months, crude oil might spell death for Wall Street. Crude is, in my opinion, the most volatile commodity. If the price rises too quickly, consumers and companies will either buy less fuel or, if possible, pass on greater fuel expenses to their customers. On the other hand, if crude prices plummet because of concerns about another variation, it might stifle employment growth in the energy sector and perhaps erode overall confidence in the U.S. or global economy. In other words, for the next 3 months, the oil market must maintain some appearance of stability. Inflation fears could reign supreme if the per barrel price rises beyond $80 once more. In the meanwhile, if it goes below $50, sector-wide investments may be slashed. The Federal Reserve speaks. The Federal Reserve's tone and actions could also trigger the stock market to plummet in the next 3 months. The country's central bank has been extraordinarily accommodating for much of the last decade. This means that interest rates have been kept at or near historic lows, allowing growth stocks to borrow at low interest rates in order to recruit, acquire, and develop. To stimulate lending and trust in the housing market, the Fed has actively purchased long-term Treasury bonds and mortgage-backed securities. However, with inflation on the rise, the Fed will have little choice but to gradually raise interest rates and reduce its bond buying program. To put it gently, investors have been spoiled with record-low lending rates for a long time. Any suggestion of a faster-than-expected rate hike may send the S&P 500 plummeting. A stalemate over the debt ceiling. It's generally a good idea to keep politics out of your portfolio. Politics, on the other hand, cannot be ignored every now and again. The Treasury Department would be unable to borrow if we reached the debt ceiling without a deal in Congress. This means that federal employees who are paid on a salary may not be paid at a time when inflation is growing. and the US economy is still getting back on its feet after a long, but brief, recession. It might even lead to the United States defaulting on some of its loans, which would have a negative impact on its credit rating. To be clear, this isn't the first time Congress has faced a debt ceiling impasse. However, the longer Congress takes to settle the issue, the more likely the debt ceiling will be a drag on the stock market. Debt on the margin. Margin debt, defined as money borrowed with interest from a broker to buy or short sell stocks, is bad news in general. While margin can magnify an investor's earnings, it can also magnify losses swiftly. While it's natural for nominal outstanding margin debt to increase over time, the rate of growth in 2021 is concerning. According to the Financial Industry Regulatory Authority, almost $936 billion in margin debt was outstanding as of October. Since the decade's midpoint, that number has more than doubled. More crucially, margin debt increased by more than 70% in the first half of this year compared to the same period last year. According to Yardeni Research, there have only been 3 times since 1995 when margin debt has increased by more than 60% in a single year. It happened in 2021, right before the dot-com bubble crashed and months before the financial crisis. This isn't encouraging for the stock market. Valuation. Valuation is frequently insufficient to throw the stock market over the edge. It's a different scenario when market valuations reach previously unheard-of highs. The Shiller price-to-earnings (PE) ratio for the S&P 500 was 38 on December 1st, and it had recently touched 40 for only the second time in 151 years. The Shiller PE considers inflation-adjusted earnings over the last 10 years. To put things in perspective, the average Shiller PE for the S&P 500 since 1870 is 16.89. What's concerning isn't how far above its historical average Shiller PE it is. It's because the S&P 500 lost at least 20% of its value in each of the last 4 instances when the Shiller PE exceeded 30. When valuations become overextended, as they are now, crashes are more likely to occur. So, that's it for today's video. What are your thoughts on our video? Please let us know in comments section below. If you enjoyed this video and want to hear from me again, be sure to hit that subscribe button and turn on the notification to our channel before you go. Thank you so much for watching.